India is rapidly expanding transmission lines, substations, and power infrastructure as renewable energy capacity and industrial electricity demand continues to rise. While most investors focus on large power producers and renewable companies, some smaller infrastructure players working behind the scenes are growing much faster. One such company has delivered explosive growth in revenue and profitability over the last few years. Return ratios have improved sharply, execution momentum remains strong, and the company operates in one of India's fastest growing infrastructure themes. But at the same time, the investors should not ignore the important concerns, including the negative operating cash flow and rising borrowings and declining institutional participation. So, in this video, let us decode whether this fast growing power infrastructure company still has enough fuel left for the future growth. Hello everyone, I am Sebi George and this is Decoding Equity, where the companies are analyzed through numbers and not by noise. And today we are discussing Rajesh Power Services, a company operating in the power transmission and distribution infrastructure segment. Rajesh Power Services undertakes projects related to transmission infrastructure, substations, underground cabling, distribution systems, and electrification work. Its clients include government utilities, industrial customers, and infrastructure developers. In simple terms, while the power producers generate electricity, companies like Rajesh Power help deliver that electricity through transmission and distribution infrastructure. India's power demand is expected to rise steadily over the coming years. The government is investing heavily in renewable evacuation infrastructure, transmission corridors, smart distribution systems, and electrification projects. As renewable energy capacity expands, the need for transmission and the grid infrastructure also increases significantly. This creates a strong growth opportunity for companies operating in the power EPC space. Rajesh Power is still a relatively small player compared to large listed EPC companies. Smaller companies can grow faster because even the moderate order addition can sharply impact the revenue and profitability. This improving industry environment is clearly visible in the company's financial performance. Sales increased from rupees 147 crore in financial year 2022 to 1628 crores in financial year 26. The company reported a 3-year sales CAGR of 99%, indicating strong execution momentum and rising project inflows. More importantly, revenue growth translated into strong profitability growth. Net profit increased from rupees 3 crores in financial year 22 to 138 crores in financial year 26. The company's 3-year profit CAGR stands at 173%, showing sharp operational improvement during the expansion phase. Operating profit margin also improved significantly. OPM increased from 7 to 8% levels in FY 22 or 23 to 12% in FY 24, and the company sustained that level in FY 25 and 26. Maintaining stable margins while scaling aggressively is a positive sign in the EPC business. If this style of analytical breakdown adds value to you, consider subscribing to the channel. I publish structured company research regularly for the serious investors. The improving profitability is also reflected in the company's return ratios. Return on equity reached 43%, while return on capital employed stood at 49% in FY 26. These are very strong numbers for an infrastructure related business and indicate efficient capital utilization during the company's growth phase. However, despite these impressive financial numbers, investors should closely monitor one major concern: cash flow. Rajesh Power's operating cash flow remained negative for the last 3 years. In FY 26, the company reported a net profit of 138 crores, but the cash flow from operation was negative 41 crores. This indicates that profits are growing much faster than the actual cash generation, mainly due to receivables buildup and working capital requirements. Weak cash generation is also one reason why borrowings increased sharply during the last financial year. Borrowings increased from 56 crores in FY 25 to 127 crores in FY 26. Interestingly, institutional investors also appear slightly cautious. Promoter holding remains stable at around 73%, which provides some confidence regarding the promoter commitment. However, FII holding declined from 2.3% to below 1%, while DAE holding reduced from over 7% to around 3.5% over the recent quarters. This suggests that some institutional investors are watching cash flow quality and sustainability carefully despite the company's strong growth numbers. The stock's valuation has also remained volatile. Despite strong growth in sales and profits, the stock corrected sharply from earlier highs, indicating that the market is balancing growth potential against the execution and the cash flow risk. The correction has made the valuation reasonable. This video is created purely for educational and analytical purpose and should not be considered as a buy or sell recommendation. I am not Sebi registered. Please do your own research or consult a qualified financial advisor before making investment decisions. Overall, Rajesh Power represents a high growth infrastructure company operating in one of India's strongest long term sectors. The company has delivered exceptional growth in sales, profits, ROE, and ROCE over the last few years, and the valuation looks very reasonable. At the same time, the investors should continue monitoring cash flow quality, rising debt, and the institutional participation carefully. Thank you for watching. I am CSMB George, and this is Decoding Equity. See you in the next analysis.